Welcome, ladies and gentlemen, it is Subayal here. Today I will tell you about the 9 key points to which my entire investment journey converges. They are literally a crux or main lessons that I learned over the past 20 years, and I wish someone had told me these points before I started my investment journey. Please take a pen and paper, take notes, and focus since these points will change your entire investment approach and make you a lot of money in the long term. Before going into the points, I will tell you why I feel it is important to share these lessons with you today. When euphoria sweeps across the markets and when the stocks are enormously overvalued, this is the time to worry. When a bubble is formed, people become overly attached to a few stocks or even worse, a few cryptos and go all in on one stock or crypto. This is not just the best way to lose your money, but also catastrophic for your financial future. No one, literally no one can predict the markets. No, the problem with going all in is that first of all, let's say you are right and you have identified a company which is trading well below its intrinsic value and has some great products lined up to be released soon, or let's say it has a good moat or competitive advantage over competitors that cannot be easily breached. Even in that case, it will be emotionally very challenging to see your stock going down while let's say other stocks are doing well. It will be very tempting for you to sell your stocks at a loss when the price is going down for weeks or sideways. You must remember that when you jump on another opportunity just because your stock does not go in the direction that you expected, it could become a repetitive exercise since the market will surely move in the direction opposite to what you expect from time to time. And before you know, you will find yourself going down the rabbit hole of recurring losses that will evaporate your capital. So please don't you ever allocate all your funds to one stock, since if one of the best investors in the world could make mistakes, so could you. Here is my 20 years of experience in a nutshell. Take a pen and paper and take notes since the points I'm going to mention are important. So here are the 9 lessons that I learned during the past 20 years of my investment journey. Number 1, invest 50 to 60% of your money in index funds or ETFs that track indexes. I made a video about an all ETF portfolio which many people loved. So if you are starting off in investing and if you have less risk tolerance, please start by selecting a few index funds and buy them slowly via dollar cost averaging. Later you can start following best investors on Dataroma and allocate a few percent at a time to the stocks which they bought in the last quarter. Number 2, no single crypto or stock should be more than 5% of your total portfolio. I would suggest that the very maximum you should put in a single stock is 5% of your total portfolio's value. Of course, when you are right just by chance or purely due to market sentiment, the best portfolio seems to be undiversified portfolio. But when you are wrong and if the market sentiment takes the stock price in the opposite direction, the undiversified portfolio will stand out as the worst portfolio. So please don't get on an emotional roller coaster because you don't have to. Avoid the overconfidence that you have insight or you are an investment genius. This humility should cap the exposure to a reasonable amount, and should something go wrong, you can recover. Number 3, a balanced approach to investing is mandatory. The key to success in investing is a consistently balanced approach over time. Sector or single stock investing may on rare occasions yield better than average results. However, over time, the market has been proven to go up fairly consistently, whereas sectors or single stocks have proven that the risk has not been worth the seldom seen reward. Number 4, your stock and crypto portfolio should never be more than 20% of your net worth. It is important because there are other ways to make money also. There are real estate investment trusts. Also, you can make your money work hard for you by getting up to 9% interest on platforms like BlockFi. This is good since a bank will give you around 1% interest, which is way less than inflation. If you put your money to work in a savings account with a bank, you lose your purchasing power with time since the inflation rate is well over 1%. I have placed a link to BlockFi platform in the description. You can earn up to $100 in free Bitcoin if you use it, but please don't use Tether while using the BlockFi platform. Number 5, ask yourself, are you gambling or investing to reduce the risk? It is incredibly tempting to go all in with one investment, but that is gambling at best. and I don't see it as a viable investing strategy. Nobody can be sure if one investment will go up or down in the future. You are betting on a hunch rather than employing a smart strategy that will stand the test of time. Diversification will reduce your risk and boost your returns in the long term. You might miss a rare big win, but you will also avoid the heartbreak of losing it all on one equity. Number 6. Really understand a company's key value drivers before making the move. Even if you want to take a concentrated approach in a stock, never go all in. In that case, only buy the stocks when they are trading well below their intrinsic value. Once again, even in that case, no stock should be more than 5% of your overall portfolio. So be sure to conduct as much due diligence as possible and really try to understand the company's key value drivers. It helps if you can confidently say you have a firm grasp on the value the company is providing and its competitive advantage before contributing significant capital to a few bets. Number 7. You should be well researched and prepared. Never diversify for the sake of diversification. Never stretch yourself too thin also. I prefer a portfolio that has no more than 40 stocks and ETFs which track indexes. Also, my portfolio never consists of more than 30 cryptos. You must do your due diligence and know your risk tolerance before investing into a stock or crypto. Over diversification can reflect the lack of conviction of an investor. When it comes to investments, conviction should be based on research, analysis, subject matter expertise, and hard work. For example, if you have spent 10 or 20 years in the software industry and you know it inside out, then you should absolutely deploy your knowledge and invest in software companies. That is not gambling. That is investing with deep conviction since the firms are within your circle of competence. Warren Buffett is a big fan of circle of competence, meaning you should know the industry in which the company operates inside out before buying its stocks. Number 8. Ask yourself these questions before buying the stocks of a company. Number 1. Is there really and truly no other stock that can provide similar performance? Number 2. Is this truly the best time to buy the stock, and is there a chance it can be bought for less during a future market event? Number 3. Can its business model be easily replicated by competitors? Number 4. If the stock performance is reliant upon current leadership, are they going to stay? And have they invested their own money in the company? Number 9. In most cases, predicting the market is catastrophic. Everyone says they can brave the fluctuations of the market and then pull out the moment they see their investment seeing the slightest dip. See investing as a long-term strategy for wealth building or retirement. Rather than predicting the markets, you will be much better off investing in index funds or ETFs that track indexes. Conclusion. Remember that irrespective of your approach to investing, meaning if you are speculating based on the ratings of analysts and their price targets, if you follow the moves of the best investors and hedge fund managers on Dataroma, or even if you have excellent analytical skills to value stocks and identify their moats or competitive advantages like Warren Buffett or Charlie Munger, going all in on one stock could be a recipe for disaster. Media does not tell you the mistakes which Warren Buffett did in his investment career. So never become overly confident that you know better and your stock is destined to go in one direction to the stratosphere. So never ever go all in on one stock. Just look at one of the best investors in the world, Warren Buffett. In 2006, Berkshire Hathaway became Tesco's third largest investor when it purchased over 300 million shares for $1.699 billion. Investing in Tesco, which is one of the biggest retailers in the UK, was catastrophic for Berkshire Hathaway. Buffett, who is famous for his buy and hold mentality, stuck with his initial investment, which ended up losing more than 700 million towards the end of the year. Another one of his mistakes is the investor in Dexter Shoe Company. Buffett said Dexter Shoe Company was one of his worst investments ever. In 1993, Warren Buffett acquired Dexter Shoe Company with 1.6% of Berkshire Hathaway stock, which was worth $433 million. Dexter was earning $40 million per year pre-tax, but soon ran into competitive pressure, suffering from dwindling sales, and ended shoe production in the US and Puerto Rico in 2001. The stock Buffett used to purchase the stock is now worth $5 billion and Dexter Shoe Company is out of business. A few of his other major mistakes include US Airways, Salomon Brothers, and Walmart. Walmart was a catastrophic disaster, and during a May 2003 annual stakeholders meeting, a stakeholder asked Warren Buffett to reveal his worst mistake in recent years. The billionaire answered Walmart. He added, "I set out to buy 100 million shares of Walmart at a pre-split price of $23. We bought a little and it moved up a little. And I thought maybe it will come back a bit." That thumb sucking has cost us in the area of $10 billion. So please be humble. Never get overly excited. Do your due diligence and never go all in on one stock or crypto. Always diversify and remember the 9 points that I mentioned. And you don't necessarily have to follow them exactly, but the point is that it is a better idea to have a strategy and a good knowledge of potential consequences of our actions, as well as the competitive advantage and past performance of the company in which we intend to invest. Let me know in the comments below which points you liked the most among all the 9 points that I mentioned. Also, would you like me to do such videos in future? Furthermore, what sort of topics would you like me to cover in the future videos? If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Also, if you like such content, please consider subscribing. Thank you so much for watching. I really appreciate it. You all are awesome. And as always, I will see you guys in the next video.